Hello and welcome to another edition of our ETF Insight series where we chat with innovative leaders from the ETF and digital assets ecosystem. Today, I'm really delighted to be joined by Rob Bush, who is with DWS Research Institute. It's great to see you, Rob. Why don't we start with you telling us about DWS Research Institute and what your role is there?
Yeah, sure. Hi, Andrew. It's great to see you. Great to be on. The DWS Research Institute is a group of professionals at DWS Asset Management, which we're charged with kind of looking at long-term strategic issues for our clients. So things that aren't necessarily, incredibly, tactical in the market, but things which will play out over maybe a 2 to 10 year cycle. So we look at things like long-term capital markets forecasts and assumptions. We spend a lot of time thinking about topics like the one we're going to discuss today, currency hedging. We think a lot about ESG. We think a lot about factor investing. And for people who aren't familiar with the firm itself, DWS, it's formerly DWS Asset Management. We IPO'd, we span out and became a public company, independent from Deutsche Bank about 3 years ago. So we're headquartered in Frankfurt, about $1 trillion assets under management. We're diversified across the sort of classic ways in which an asset manager can be diversified in terms of the different types of clients we service, the different geographies that we operate in, but also the assets that we manage and the strategies that we run as well. So we do the whole gamut: active, passive, alternatives.
And so, how would you, with this background knowledge you have, how would you suggest or discuss with an investor, what is the best way, or how do they go about getting currency exposure in their portfolio?
Well, the question of currency exposure in the portfolio is a very critical one, Andrea. And I think it's one that we would probably argue doesn't always get the attention and the analysis that it merits. So let me sort of take a step back and explain why I think that. I mean, the first thing I would say is that, if an investor, let's assume an investor is US-based, right, to keep the conversation straightforward. But if a US-based investor invests internationally, as we and probably most others would argue they should, the first thing to recognize is that if you invest internationally on an unhedged basis, which most people do, you have full currency exposure. So if you're buying an asset abroad effectively and it's trading in a non-dollar currency, you have full exposure to that currency as well as to the asset itself. Now, that may sound obvious, but it's not something that we find is immediately intuitive to people. And one thing that we published on that we think was quite interesting, and we hadn't seen this said before in the industry, is that actually we think that unhedged is leverage. And I'll explain why I say that, Andrea, because if you think about a straightforward 50-50 equity portfolio, okay, half your money in the US, half internationally, we would argue you've got another 50% on top in currency. So now you've got 50% international, you've got 50% domestic in equity, but you've also got 50% in international currency, and that adds up, of course, to 150. So we're arguing that for $100 down, you've got $150 worth of movement in assets, effectively. So we came out and said, quite a bold statement, really. We said that actually a traditional portfolio is probably levered.
Yeah, interesting. And so in terms of, we're talking about currency, obviously currency risk in a portfolio, how does that, typically impact the returns of the portfolio? I mean, I know it's obviously, maybe like we have to look at historical because obviously you can't predict going forward, but what are your thoughts on that?
Well, it can obviously change, right? And it's very dynamic. The way to think about it is that, first of all, it's going to matter how much international you do, right? Obviously, the more you do, if you're unhedged, the more currency risk you're going to have in the portfolio. That's the first point. It's going to matter how risky the international currencies are at the moment. So their own volatility will impact the total volatility of the portfolio. There are times when international currencies are relatively stable, and we've seen that for some years. And there are times, and we're seeing it a bit more now, when they're not stable at all, and they're really quite, they move around a lot. I'll tell you one surprising fact, actually, is that people tend to believe that emerging market currencies are more volatile. And that's true individually, but it's not true as a basket, because a lot of emerging market currencies are either pegged to the US dollar or heavily managed. So actually, that's an intuition that many people get wrong. I mean, it's certainly true that individual emerging market currencies can be very volatile, but as a basket, because currencies like the Hong Kong dollar make up a large part of that basket, actually they can be less risky than you think, but it still merits individual analysis, I would say. And then the other thing that matters is the correlation between the currency and the asset that you're buying, and that can be very different depending on which country you're looking at. So to give you an example, it's quite typical in Japan to see the yen having a relatively low correlation to Japanese assets. It's quite typical in emerging markets to find the currencies having quite a high correlation to their own asset markets. And that's going to be a very important feature of the risk.
So in terms of, clients who are looking to, hedge their portfolio, like what is the best way for them to, weigh the decision to hedge, and how do they go about that?
Yeah, so we don't argue that, we're not dogmatic about this. We're not saying you always should or shouldn't hedge. What we're saying is just give the decision its due consideration. Think about it, analyze it, and consider your options. That's really what we're saying. And that wouldn't be helpful, advice on its own unless you said to people, well, what are the things I need to think about? And we've really identified four. We say there are four things you need to think about, in order to make a sensible decision about whether or not to hedge. So the first one is obviously the kind of your forecast or your belief about what the foreign currency is going to do. So if you have strong conviction that the international currency that you are exposed to is going to appreciate against the dollar, then it could be fine to be unhedged, because that would be an additional source of return. Now, you have to have quite a frank conversation with yourself about your ability to forecast international currencies. That's very challenging. And Andrew, there's a very important point here, which is that, unlike equity markets, we don't believe that currency markets have a built-in risk premium. So we don't believe they pay you over the long run. And that's a very important point. Intuitively, if I said to most people, would you rather have exposure, in your retirement account, let's say, to an equity market or to a currency market? Most people say equity, and I think that's because most people understand that there ought to be a long-run growth component in an equity market. We don't think that's true of currency. So that's the first thing, is the currency return. The second thing is the risk of the currency that we just discussed. So you have to have a view on how volatile you think the currency is going to be. That's also quite a challenge. But one thing you can say is that it's going to have a positive volatility, no matter how high or low you think that will be. It will have risk. And then the third point is the correlation point. Again, quite intricate, quite challenging, but you must think about it because it's part of that risk. And then the last part is the cost to hedge, which is that most people assume that there will be an explicit cost to hedging. It's almost like buying an insurance premium. You believe you have to pay to do this. That can be true, but it can also operate the other way, because the main component of the cost to hedge is the interest rate differential between the US and the economy that you're hedging. And if you have a situation like we do today, where US interest rates are higher than, for example, European or Japanese interest rates, what that can mean is that you actually have a positive cost to carry, which is a fancy economic term, meaning you get paid to hedge effectively. And when you can think about getting paid to risk, to reduce risk, that can really seem like an interesting thing to think about.
Within your role, I know you're expansive across the all of DWS, but being able to help the passive team and kind of going into the ETF sides of the currency hedged ETFs that are offered at DWS. Sounds like a really great way for you to be able to help do that deep dive for investors who are looking to get that exposure. But thank you, Rob, so much for your insights. I really appreciate it. And for those of you who are watching, if you'd like to watch this video again or watch additional videos, you can go to blackwatersearch.com. And thank you for watching.